Welcome back to another action-packed episode of Taxed Enough Already, where we only talk about exhilarating topics like high finance, economics, and taxation. I'm your host, Dan Nuwash. In this episode, we have a returning guest and one of our resident experts over a multitude of tax and high finance plans we use, Tom Bacharach. Tom gives us some phenomenal insight into how business owners who fit a specific criteria can implement a strategy or strategies, depending on the situation, that can potentially offer that business owner a six-figure tax deduction and potentially get an additional 20% break on their earned income through that business. Like many of the strategies that we use, this isn't new, it's just commonly overlooked, and while it has many names, 412(a)(3 plans, pension plans, etc., it's most commonly known as a defined benefit plan. Before we jump into this episode, let me provide a quick background over Tom. Like most of our guests, Tom is a military veteran and he earned his veteran designation as a former Air Force officer. Tom is currently the Vice President of Marketing and Sales at RMC Group, and he has been with RMC since 2007. Tom has a wealth of experience that is in, but not limited to, the creation and design of multiple forms of business efficiency strategies, risk mitigation methods, employee benefit plans, the creation of mid-sized profit centers, and more. Tom has been in the financial services industry for over 37 years and has held a variety of differing roles, some of his most notable being a regional vice president of AXA Distributors. In July of 2004, AXA purchased Mutual of New York, or MONY. Tom was a founding member of MONY, the then newly created brokerage life division. Tom has held additional roles such as agent, sales manager, benefit manager, TPA, and he spent 6 years with BISYS as a brokerage manager. So it's not just the encyclopedia of designation that follow Tom's name that make him one of our resident experts we rely on. It's his wealth of experience, his dedication to duty, and dedication to his clients that drew us to having him as that resident expert.
I just want to chat a little bit about where we are. And thank you, Dan, for inviting me to talk a little bit about defined benefit plans today. And where we are is currently in the middle of tax season. So for those advisors and those people, this is really the time, probably the best time of year for somebody to figure out whether a defined benefit plan is going to be right for them, because they're going to come right off of doing their taxes and realize that they have a tax problem. Now, it may take a little bit of time for them to actually put some of this in effect, but this is the time where you want to talk to them. And with that in mind, rather than getting extremely wonky into the weeds and talking about things like Secure 2.0 and all that kind of fun stuff, let's talk a little bit about very high level, really what a defined benefit plan is, and then how you open the conversation with somebody when you find out that they've got a tax problem or that they may be right for this. What is that elevator speech, as they say? Well, okay. So a defined benefit plan is exactly what we would think it would be. You're defining a benefit. And unlike a defined contribution plan, like a 401k or SEP, we're actually shooting for a target at normal retirement age, where we're going to say, okay, that's the bucket you've got to fill up. And then you reverse engineer it backwards so that you're saying, okay, this is what I have to pay in order to get to that target at retirement. And so you're defining that benefit. You're saying, okay, you can get up to $275,000 a year guaranteed for the rest of your life. Now, that's going to be pretty expensive, but remember, there's a tax deduction involved with that. And for those business owners right now that are, and we're going to actually define what I would consider a successful business owner on one of the slides, they're getting harmed in taxes. And Dan, what is the constitutional statement about taxes?
It's also our business motto, and that is, it's your moral and patriotic duty to pay less in taxes.
So when we're talking to business owners, if you look at them as a group, they put their heart and soul and their entire thought process into that organization. and that becomes their life for an extended period of time. What they may want to feel is at some point, when did we start taking money out of the organization so they can live their life after that organization has, they've put it in the rearview mirror? Now, you may never retire as a business owner, but you will at least want the option, and this is going to give you options. So a defined benefit plan is an easy way of setting up a pension so that you don't have to worry about it in retirement. And a lot of times with a defined benefit plan, it's not taking away the after-tax investments that you're going to do or the non-qualified investments. What it's going to do is it's going to give you a basis, a floor, where you know that money's coming in. And if you think about it, when you're putting together these defined benefit plans and maybe even layering on a 401k, a defined contribution plan, which you can do, if you know that money's going to be there, when you're investing in your managed money or your investments or your stocks, bonds, mutual funds, how much more aggressive can you be knowing you've got money in the bank for retirement? You can certainly be more aggressive. And so it gives you a little bit of freedom in your investment philosophy by doing this correctly.
So while you're pulling that up, Tom, we were talking about timing earlier. And with us being in tax season now, where people are filing their taxes for the tax year of 2023, is this still a feasible strategy for someone to get a tax deduction for 2023?
Well, yes, yes, Dan, it actually is. And up until about 2 or 3 years ago, I couldn't have said yes to that statement because with the passage of Secure 2.0 and its predecessor, Secure 1.0, it changed things because it used to be, okay, I've got to have the forms in signed and dated as of December 31st. Now with Secure 2.0, it is whenever you file. So, for most people, if you're a certain type of entity, it's March 15th. You may even go on extension. So long as we get the paperwork in and create the accrued liability, which creates a plan, prior to you filing your taxes, you can still do these plans. The only limitation is, and we'll talk a little bit about this later, if you're using life insurance, you can only backdate life insurance 6 months. So anytime that we would do this, if you're using the fully guaranteed plan, which is called a 412, the last date that you could apply or have the policy would be June 1st, because you only get 6 months to backdate it, because those plans have to be dated before the end of the year to get the tax deduction in that year.
If there is not a life insurance element, what's the timing scenario in that case?
It would be when you file your taxes. It has to be put in place and you have to fund it before you file your taxes. So if you're using just fixed annuities or in the options where there's investments, that has to be funded before you file your taxes. And if you do notice, if you are attention to detail, as I am, that is an Air Force pin.
It's okay though. We won't hold that against you.
Okay, good. All right. So let's talk a little bit about defined benefit plans. They really come in 3 flavors. 412E3, which is the most conservative with the highest tax deduction. It is fully guaranteed. And by legislation, those products that you would use inside of a 412E3 have to be fully guaranteed. It is good for smaller size organizations where the owners are older and making substantially more than the employees. Defined benefit plans, whether they're a 412, a traditional defined benefit, which is the same kind of thing, same kind of setup as a 412, but instead of using fully guaranteed products, you can use stocks, bonds, mutual funds, more of an investment managed money type of flavor.
So it sounds like what we would call a top-heavy company, right? So maybe a family-owned company that has a lot of the owners, managers, shareholders that are highly compensated or family. Can you give a little more detail on the ideal company or business?
It would, like I said, it's probably older owners, probably no more than say 5 employees, including the owner. You can change that. Like if you had, 8 employees and 3 of them are family, we can still do it. But the smaller, the easier it is, because the vast majority of the benefit is going to go to the business owner, or that's the way that we want to structure this. If you have a very expensive plan that is paying for a large percentage to the employees, what will happen is probably year 4, 5, or 6, the owner is going to go, why am I paying for the employees? And then they're going to shut down the plan. That is much more flexible at the smaller sizes.
Okay. What about the business industry or sector? Is that a factor in this?
Not really. Are you a profitable company that is looking for tax deductions? Go over it again. The 412 is very conservative for fixed products. Traditional defined benefit, same type of structure, but using equities. And then you have what you hear in the marketplace as a cash balance plan. Cash balance plan is kind of a hybrid between a defined benefit that we just talked about and a defined contribution, because in a defined contribution or your 401k, you're saying, okay, I know what I want to put aside. I hope it grows to something. Or you're going to say, I want to put away 10%, 12%, 15%, 3%. You can do that in a cash balance plan. The difference is in a cash balance defined benefit plan, you're usually using a much higher percentage for the business owner. Say you're going to put 12% of total compensation away for the business owner and maybe 3% away for the employees. So you can break it up into different sectors. And really, the idea here is defined benefit plans are great plans, but it's really going to be dependent on what the goals of the organization or the business owner is. What is their appetite for a tax deduction? How many total employees you have? And what's your investment appetite? If you came to me tomorrow and said, hey, I've got a group and it's 23 employees, can we do a 412? I would say no, because it's going to be just so blessed expensive. It's not going to make any sense. But that may be great for a cash balance plan. And we may also look at, what are they already doing? Do they have a defined contribution plan that we can maximize that amount going in there, but also layer the 412 or the traditional defined benefit or the defined benefit cash balance plan in there as well to maximize the benefit for that business owner? Really kind of, give that retirement plan, on steroids, if you will. So different ways to do that. And like I said, it's not uncommon for a business. Let's just say that business owner started a 412 because he knew a 401k 10 years ago when he was, just starting out and had 5 employees. Well, now he's got 25 employees and he's doing $20 million a year and he's just getting absolutely hammered in taxes. Well, let's not get rid of the 401k because it still is a very valuable component. But let's layer on something that gives him more money to be able to put aside. Because the problem with the 401k is it's a great retirement plan, but it treats the business owner the same as the secretary up front. Not that there's anything wrong with the secretary, but that business owner is at much more risk. So they should be able to put away more than the average employee. So
okay,
there's a way of taking improving with what they have. It's not bad. It just may be better.
I might be jumping ahead here, but I know there is specific deduction or limit due to the Tax Cuts and Jobs Act, Section 199A, that applies to certain types of businesses.
Well, that's a very little known, not well known as it should be. Unfortunately, if you're a service organization, a CPA, you own a real estate, trust. My wife is a dog trainer. Those service organizations can qualify for an additional deduction under 199A of the code. I believe last time I looked at it, the cutoff was you don't get to claim that if you make more than $380,000.
That would be the QBI, right? The qualified business income. If it is above $380,000,
you don't qualify, right? And so what you can do is take that business owner that's making $500,000 and write them a defined benefit plan for $200,000. You've now dropped them down to $300,000. You're giving them a large tax deduction on that, but you've also given them a 20% deduction because now they qualify for 199A. The crazy thing is when you think of retirement, people don't. And that's just the stark reality. And the scary things that are impacting retirement is people that are born now. There is somebody out there that is going to live to 150. That is crazy. That means we have now officially become tortoises. It's just crazy to think that. But if you're only working 70 years, that means you've got 80 years of retirement. And that's crazy. Are you putting away enough in retirement? Are you going to outlive your savings? And as a business owner, are you thinking along those lines? And how can we get as much money out of your business to help subsidize so that doesn't become a problem? Because the reality is that only 10% of people that are retired have really enough money to live at that pre-retirement lifestyle. Now, okay, that's a great statement. You don't really need as much in retirement because the three stages of retirement are your go-go years, your slow-go years, and your no-go years. So you're going to have different positions that you're going to have to pay for. But in those go-go years, you want to be able to go play as much as you possibly can. So anyways, and what the scariest thing is if you think about it, you retire at a certain level, and hopefully you live 22 years in retirement, which means, let's just say that if you live to 87, when you get to 87, you're living at half of the income that when you started. Have you put away enough to be able to subsidize that? Can you put away enough? Yeah, the answer is yes. So the other factors obviously are investment risk, health, and long-term care. Long-term care we can address with some of the things in the life insurance policy. Now, before I go on, I'm actually going to go back. Let's talk about life insurance. Life insurance can be used in these type of plans. It is a form of conservative investment. Is it required? No. Should it be in a plan? That all depends on the needs of the individual. And what I mean by that is if you've got to buy life insurance, why wouldn't you do it on a pre-tax basis? So you can do it that way. But if you think about retirement planning, what can happen in retirement? You live, you die, you get sick. You get sick, you have to go into long-term care. The way that life insurance plans are designed now, they offer long-term care, terminal illness, and accelerated benefit riders. So if you had life insurance in your plan, it would be self-completing because that death benefit would help pay for it, but it would also provide for being sick and dying. So that's truly a retirement plan. If you think of a 401k that doesn't have life insurance, all that is a money pit. It's not a retirement plan. It's just money for retirement. This is actually a way of planning for retirement. And what is it that when you're talking to business owners, they need to know about? What is the proverbial elevator speech? Well, it is as the slide dictates. It is the largest tax deduction currently available under the IRS for qualified plans. And if we just take a 50-year-old male and we use 50% life insurance, they can put up to $250,000 a year away. And this is just the example. Now, Dan, you're an investment guy, or were at one point. Most people are going to say, if you say, I can give you 1% or 6%, what are they going to say?
They're going to say 6%, of course.
Right. That's great. And yes, if you're using non-qualified money, or if you're not looking for a tax deduction. But the difference is in a 412, which is fully insured, and you will actually use probably about 1.5% as the guaranteed rate, not the actual rate, but the guaranteed rate, compared to a traditional defined benefit plan or maybe a cash balance plan where you're using managed money and let's just say you're getting 6%. The difference is that in a 412, you can put $250,000 away. In those other plans, you can only put about $150,000 away. And you say, well, I'm getting to the same point for less money. Yes, but you also lost $100,000 tax deduction. What type of an investment do you need to have to make up for $40,000 of real money that's going back into your pocket as a tax deduction. Pretty substantial. And that's year over year as you make those contributions. So it's really a tax play. The other thing is that this is guaranteed income that you cannot outlive. It is a pension. Now, just as a matter of course, while we're having that, we'll get to retirement age. And when you get to retirement age with these type of defined benefit plans, you have to make an election. Am I going to take that income guaranteed for the rest of my life? Or am I going to take that lump sum of money? RMC, the company I work for, has literally managed and put together tens of thousands of plans over the 50 years we've been doing this. Less than 0.1% of those participants that retire from these plans actually takes the income. The reason being is, if you were to actually take the income, that $275,000 a year, it would take 15 years to get that money back out of the plan that you put into it. You also lose control because you're giving the money to the insurance company. If you die, that dies with you, unless you choose annuity options that pay for a spouse, and in which case that's going to be dramatically cut. Wouldn't you rather take that $3.5 or $4 million and be able to roll that into a self-directed IRA where you have complete control of it and you can pass it on to your heirs? You're also probably going to get a better interest rate, because when you leave the money with the insurance company and they give that to you, they give you what's called annuity purchase rates. Those annuity purchase rates have been, and probably will be for a substantial time in the future, fairly discounted. And so you're not going to be getting 6, 7, 8, 9%. You're not going to be able to invest in, Nvidia or, Apple or Tesla. You're going to be stuck plodding along at that rate. So you have that option at that point in time. So you've got guaranteed income, but you've also got options.
Speaking of return on investments, especially when you're working with wealthy clients, wealthy individuals, families, what I've seen and experienced, and what was taught and trained in me by many people much smarter than myself, is wealthy individuals, once you become wealthy, high rate returns is much less important than wealth preservation. All right, so wealthy individuals are not the type of people that are going to put half of their assets into Bitcoin or cryptocurrency. They're much more concerned about wealth preservation, and most of their advisors are going to be pointing them in that direction as well. Also, another concern for the wealthy is taxes. In my experience, the wealthy are much more concerned about taxes than high rates of return, because if you're wealthy, your tax rates tend to be significantly higher.
We've now put this money into the plan, but what this plan also does is, because you have those options, it can help reduce, eliminate, or diversify your current stock market risk, your exposure, if you will. And again, if you're reducing that amount that you're exposed in the stock market on one side of your investments or one side of your portfolio, how much more aggressive can you be on the other side? You can go after those large returns, because you know that if you fall, you have, a safety net in your retirement plan. And then the last part, as we were talking about, and kind of dovetails with your point, Dan, it's a way of purchasing estate planning tools, life insurance, annuities, investments on a pre-tax basis. Yes, you should have pre-taxes. Yes, it's going to give you tax deductions. This does not eliminate what you should be doing on the outside. I can't tell you how many times I've had a very aggressive business owner say, "Oh, I love this. I'm going to put all my money into it." No. Okay, you just said you wanted to put $250,000 a year away. Let's do this. Let's put $200,000 into this plan so you get the tax deduction, and take $50,000 and put it in a non-qualified version, so that we've not only diversified your exposure, we've diversified your tax exposure. You should have money in pre-tax and in post-tax. And then you kind of look at this, and this is great, but it's not always easy to turn to a business owner and say, you're going to put away $200,000, you're going to put away $150,000. So the question then comes, how do you actually get there? how do you kind of help them soften that blow of hearing you're going to put away $150,000? Well, again, I think we all can say a successful business owner probably is making the minimum of $500,000 a year. All right, so if that's the case, then can we also agree that they probably have about $10,000 in monthly expenses? Probably that's probably actually pretty low. But for the sake of our argument, we're going to say $10,000 a year, $120,000, $200,000 before taxes. Take that right off the table, because if you're going to change somebody's lifestyle, they're not going to do it. They may do it temporarily, but it's not going to be a long-term play, because they're going to still want to be able to do those things. So that leaves us $300,000. And at that level, I'm going to say you're probably at somewhere around a 40% tax rate. So Mr. or Mrs. Business person, because of your success, you're going to have to write a check to the government, send a check to Uncle Joe down in Washington for $120,000. So the question really comes, of that $120,000 that you were so successful that you had to pay for, how much of that do you want to save?
Ideally, all of it.
Right, all of it. So in that case, let's set up a defined benefit plan for $120,000 in your case, and defer that cost of success so that you can keep the money. If you've got to write a check, it's better to write one to yourself than to the government. And so that's really how you get there with somebody. This is the thought process. This is what a defined benefit can do. When you have this conversation with a business owner, then at that point, the next part of setting up this plan is really just getting a census with date of birth, date of hire, and compensation. And then we sit down and go over the numbers. It's almost useless once you've gotten to this point to say, okay, let me give you the numbers first. Because we're going to want the CPA involved. We're going to want them involved. And I would say in 90% of the time, somebody is not going to be able to tell you what they want to spend until you show them what they could spend. We're going to show a maximum. We're going to show a minimum, or not a minimum, and then a lower amount. And it's not uncommon, for a 5-person business with a successful 50-something-year-old a doctor, and he's got 4 staff. Then we're going to come back and we're going to say, okay, this plan's going to cost you $500,000 on a maximum, but you could put in $150,000. They're going to go, I don't want to do the $500,000. I can do $200,000. Okay, then we can walk through that illustration and do another iteration so that they can get comfortable with what it is. We let them choose what they want to be able to spend. It's not up to us, it's up to them and their account. So that's just a quick and dirty on, defined benefit plans, how you get there, how you start the conversation, kind of the mindset that you want to put with that business owner to say, okay, why do you want to give me that valuable information in your census and the structure of your company? Well, in order to give you some real numbers to get a request for a proposal, I need to get some information. You've been given this. If you're willing to proceed at this point, that's what I need, just a census and some basic information about your company. Whether we go 412, whether we go traditional defined benefit or cash balance, whether we take their existing defined contribution 401k or profit sharing plan and stack it on all of this, well, that depends on really what the client wants to do, but really it comes down to, really the better information that we get, the better information we can give back. And so that's kind of the first step of how we really kind of talk about and where we really go to when we're talking about defined benefit plans. Any questions?
I do have a couple questions, but you also have a couple gears turning here. So I know when it comes to defined benefit plans, there's different types of defined benefit plans, right? 412E3, 412I, cash balance plans, etc.
Well, it's 412E3, traditional defined benefit, which is actually 401A, and then cash balance plans.
412E3s require you to use fixed income products or fixed products.
Guaranteed
right?
products.
Being that we're now in a high inflation market, the number one policy for the Fed to combat inflation is generally they increase interest rates, right? Increasing interest rates really makes money more expensive. But with that also comes along the side effect that interest rate on fixed products or guaranteed products, whatever we want to call them, generally tends to increase. So is that almost a benefit?
Benefit because you're going to be getting a better return on those guarantees because they're going to start ratcheting those up. But with a higher guarantee, you're going to get a lower, it's going to take a shorter period of time to get to that target benefit. So you're going to get a slight reduction in tax deductions. But remember, we may say, okay, this is a 412 right now. There's nothing to say that if things change, their investment philosophy changes, things, go back to the roaring 90s where, it was just crazy and it was an extended bull market. You can change the type of plan that you have to a traditional plan or a cash balance plan. That money is there that can be moved. It may cost a little bit in fees, but it may be worthwhile because, Dan, as you put in a very nice manner, money flows from fixed rates to investments all the time. Disintermediation is a constant. One of my favorite words.
Okay,
And thank you for giving me the ability to actually say it publicly.
you got a bunch of Marines on here though, so don't go over 3 syllables with your words. All right. I'm sure a lot of us took some decent notes, but I took some decent notes here, or what I would call some decent notes. So to summarize some of the key advantages, a qualified defined benefit plan can provide substantial retirement benefits without market risk, specifically when we're talking about a 412(b)(3). From a retirement standpoint, it gives the largest tax deduction under the law. It can provide guaranteed income you cannot outlive. It reduces, diversifies, or eliminates market risk, allows you to buy estate planning tools on a pre-tax basis. There is no full funding limitation under IRC Section 404A1A. There's no quarterly contributions that are required, and there can be no underfunding because contributions are based on the guaranteed provisions of the level premium contracts. Anything I missed there in the key advantages?
I'm going to redefine it. It's because this is an ERISA governed plan. Qualified plans, whether cash balance, traditional defined benefit, or 412, can neither be overfunded or underfunded.
Now, all of that sounds great, but are there disadvantages to this plan?
Yeah. This is something that you're setting up that's going to be for an extended period of time. This is not designed for that windfall year. Oh, I got to save a lot of money. This is something you're going to be doing for probably 3, 5, 7, 10 years, preferably the latter. If you were to set this up for 1 or 2 years and then shut it down with a large tax deduction, the IRS will come knocking and say, why'd you shut it down? And you have to be able to prove there was a substantial reason why you shut it down. If not, then you set up a plan not for retirement plans, but for tax avoidance, not what it was designed to do. It also, for employers, you have to carry employees. There's mandatory limits. You don't have to carry all of them, and we can go into that at a later point. But you do have to carry your employees. A lot of times business owners are saying, this is great, but I don't want to have to pay for my employees. Yeah, sorry. If you're going to want to be able to have a substantial tax deduction, your employees are what is allowing you to be able to get that tax deduction. So there is a carry cost for them. Now, the way that we want to design it is that we want to get 70% of the benefit going to the business owner, because at that point, from a tax standpoint, there's no net cost to carry the employees.
Is there a provision for policy loans or loaning against this type of plan?
In a 412, there is a loan is a prohibited transaction. In both the cash balance and traditional defined benefit 401A, you can have a loan provision. Just like you have in a 401K. There's a loan provision, but you've got to pay it back. And that's really contingent upon how the employer wants to be able to set that up.
Seems like maybe one of the last potential disadvantages, and this again might be based off of the type of defined benefit plan you have, is the investment allocations might be limited.
In a 412, very limited. In a traditional defined benefit plan or a cash balance plan, it's really what type of managed money you want to be able to offer. It depends on the platform. Yeah, you're not going to be able to invest in real estate, but you're probably going to have a full array, whether it's with Voya or Principal or John Hancock or Schwab or whatever. Wherever that house is that you take it, they're going to give you investment options. That's going to be the limitation. Now, what was the question that y'all missed?
I'm not sure. I think you need to enlighten us.
Right. All right. So yeah, that was kind of that made you step into it. For that employee that stays for 2 years and I've funded for them, they're going to take that money and run. Well, no. In these type of plans, you set up a vesting option. The typical vesting option is you don't become eligible to after 1 year, and then you're vested over a 6-year period, 6-year vest, 0, 20, 40, 60, 80, 100. So that means that Janet, the receptionist up front that's been studying to get her master's degree in microbiology, is not going to stay there forever. 3 years into it, you had to put $10,000 a year away. You put in $30,000. Well, she leaves at the end of the 3rd year, 0, 20, 40. You're gonna have to give her 40% of that benefit because she stuck around for a little bit. But 60% of that benefit goes back into the plan to be distributed amongst the active participants. So to some extent, it can also be a way of setting up some golden handcuffs.
That vesting period is a longer vesting period than like a traditional 401k.
Typically, yeah. But there's a multitude of vesting options, just like in most of the provisions. If I'm using very generic terms, there's always something that can be different. You could set it up as a 2-year eligibility period, which means, and that doesn't happen very often, that means there is no vesting period. They're immediately vested. But for somebody that has large turnover, doesn't keep anybody for more than 18 months, that may be a better way to go.
So there you have it, folks. If you've had the mental bandwidth to stick around this long, I thank you and applaud your mental stamina. One thing to clarify here is I asked Tom during this episode if there's still time to get this tax deduction on your 2023 taxes. And yes, there still is. You can implement this or these strategies at any time. But if you want to do this for your 2023 taxes, you may have to file an extension, and depending on the structure, you may have to have that plan finalized by June 1st of this year. We've included all relevant contact information and sources below, and as always, any like, share, follow, comment, or any type of interaction with this is not only greatly appreciated, it is a phenomenal and free way to support a veteran-owned and operated business.
This presentation and all material within it are for informational purposes only and does not provide tax, legal, accounting, or financial advice. Any view and/or opinions expressed by speakers are not representative of Finance for Thought, FFT, RMC Group, their affiliates, or affiliated brands. Please consult your own tax, legal, or accounting professional before making any decisions.